I think actually what investors have done is they've taken a look at this latest round of tariffs against China and taken a, I guess, a cup is half full view, because the initial threat was going to be 25% import duty on those $200 billion worth of goods from China coming into the US. And they sort of went light and imposed a 10% import duty. And then, of course, overnight you're hearing rumblings that China may actually start cutting their import taxes for their large trading partners. So I guess that the view that strategically the administration was gearing for something, less than a trade war, as per Jamie Dimon's choice of a skirmish, I think that that's really one of the helpful factors here today. But don't forget that the US dollar is also rolling over here, and that's breathing some added liquidity to the global marketplace. So that's a big story here too, is that when we saw the angst in emerging markets and the volatility a couple of months ago, that was predicated largely on a runaway US dollar. That's a big story today as well. For whatever reason, maybe the crowded trade in the greenback is dissipating, but that's a big reason why equity markets are taking on a better tone currently.
Yeah, David, a few, I guess last week you wrote, and I'm quoting, "In due course, we shall all find out that the U.S. economy will no more be able to fully decouple any more from the rest of the world than it did back in 2008. Do you still feel that way? I mean, Larry Fink this morning at a Yahoo event arguing that the U.S. has in fact decoupled from the rest of the world.
Well, I don't believe in decoupling in the most globally interconnected economy that we've ever seen in our lifetime. And I was saying that back, in 2007, 2008, when the rest of the world thought that it could somehow miraculously decouple from the United States. We're far too intertwined. I think that what people call decoupling is a euphemism for lags. There's just lags. We've already seen, for example, when you look at the OECD leading indicators, they're down 8 months in a row. Even in the US, they're down 4 months in a row. It's not portending necessarily a recession, but my sense is that it's going to be very difficult for the US economy to generate the 10% earnings growth that's priced into the equity market right now for 2019 under a scenario where nominal GDP growth is going to be below 5%, which I think is a reasonable forecast at this juncture.
So, David, it sounds like you think U.S. growth is going to slow in terms of this argument that you won't see meaningful decoupling and that potentially stocks could move lower from here. Is that the argument?
Well, look, it's not just what's happening with emerging. Yeah, well, look, the emerging market economies right now, I mean, their markets have stabilized because interest rates have backed up sharply in a lot of these countries. More is to come, and I've never seen a situation where higher interest rates leads to stronger aggregate demand growth. And then you've got the other elephant in the room, which is the Fed. And remember that Fed policy influences the US economy on its own with lags that are long, variable, and often insidious. You remember Ben Bernanke stopped raising rates in the summer of 2006. We didn't see the full lags, right, until the summer of 2007. So we got the Fed raising rates. They're going to continue to raise rates until something happens, either a sharper slowing in growth or something in the financial markets. And don't forget that next year, the balance sheet unwind is going to be $600 billion after $400 billion downsizing this year. So I think that liquidity, maybe not to the naked eye today, but liquidity is going to be a big challenge for the economy and for risk assets as we move into later this year in 2019.